Hey YouTube, I'm Jimmy. So for anybody watching yesterday, the stock market took a serious nosedive, falling about 800 points. So there were a few things I wanted to bring out in this video. First, I wanted to look at why it happened, what do we think will happen next, and are there any opportunities popping up because of it happening? And then stick around to the end of the video, because at the end I'm going to spend a minute on using this type of market crash to get a better dividend yield. So before we go ahead and freak out about what's happening with the market, let's try to get a bigger picture of what's happening with the S&P 500. So as of yesterday's close, which was December 4th, 2018, the S&P 500 is down a bit over 2% for the month of December, and we're only a few days into it. In November, the market was up about 2%, and in October, the market was down about 7%. October was one of the worst months in many years. Although when we look at all of 2018, we can see that the S&P is up just short of 3%. I bring this up because I think it's important to keep things in perspective. So if the market was down, let's say 20% for the year, well, then this would be a very different video. Now, I also get that the market is coming off of a 2017 that looked like this. Last year, the market was up about 22%. So if you just got involved in investing after watching last year and you're sitting here in 2018, I'm sure 2018 seems to be a bit crazy. But this happens, and personally, this is why I'm a long-term investor. I generally try to ignore the noise and just keep our eyes open for different opportunities. So our first question is, why did it happen? And some of the early headlines yesterday were saying it was due to the trade tensions between the US and China, and I'm sure that played into it. But to me, that's just a tip of the iceberg. The real question when looking at an iceberg is, what's underneath? How big is it? And to me, this points to the overall economy, more specifically, the yield curve. So you may know that an inversion of the yield curve is often an early indicator for a recession to come. We actually did a video called 5 Tools to Predict a Stock Market Crash that dives further into this. If you're curious, there's a link in the description below for that video. So yesterday, the yield curve started to flatten out a bit because the 10-year Treasury yield started to fall. And to illustrate how much of an impact this could have on the stock market, this is a chart of the S&P 500 yesterday. And don't forget, the market fell 800 points. It's the orange line. And the blue bars, well, they're the 10-year Treasury yield. And as you can see, during yesterday, the market and the 10-year Treasury yield really moved in lockstep with each other. Now, to me, this is a big indicator that the 10-year Treasury yield had a lot to do with yesterday's crash. So the next question is, what do we think will happen next? And obviously, the yield curve is something that's on the market's mind. So I think that's something we need to track going forward. But before we get there, let's look at how much flatter the yield curve actually got. And we can see that this is a chart of the current yield curve. And as you can see, it's moving higher, which is a good thing. So now let's go ahead and add the yield curve at the start of 2018. The orange line is the start of the year. The blue line is the current yield curve. And we can ignore the fact that yields are currently higher. What we care about is ultimately the shape of the yield curve. And if we overlap them like this, that'll make them a bit more comparable. And we can see that the current yield curve is in fact flatter. So what does this mean, and where are there opportunities? Well, ultimately, what it means is what we already said in our 5 Tools to Predict the Stock Market Crash video. We need to keep an eye on the yield curve, and preferably a few other indicators as well. But this is only important because of what a recession would mean to the earnings per share and the cash flow of the companies that we invest in. Because at the end of the day, it will be cash flow and earnings that ultimately move any individual stock over the long run. So now let's imagine for a second that the yield curve does in fact invert over, let's say, the next year. The question is, does that inversion cause a recession? Does it lead to another stock market crash? It could. But I think that what's worth noting, although all recessions have been preceded by an inverted yield curve, not all inversions of the yield curve have led to recessions. What that means is basically that the yield curve isn't always right. So then we should ask ourselves, what does a recession or a slowing economy, or potentially slowing economy, mean for our companies? Will it hurt earnings? Will it hurt cash flow? And if we own mostly, let's say, cyclical companies, then perhaps our portfolio will be more sensitive to the business cycle, and this would have a much bigger impact on us than a portfolio full of defensive stocks. And this brings us to the opportunities. And if you've been following this channel at all, then you might have seen some of our Dow 30 videos where we're analyzing all 30 stocks in the Dow Jones Industrial Average. And then when we're done with that analysis, we're going to go ahead and try to build 3 different portfolios: value, growth, and dividend. But what will ultimately really happen, and this will happen for us and will happen for anybody who does a thorough job of building their portfolio via in-depth research, is that what will happen is we're going to come up with a handful of companies that we really like fundamentally, but they're not at the right price just yet. And this is where market crashes like the one back in October and the one yesterday can give us great opportunities. I happen to be looking at which companies in the S&P 500 performed the worst yesterday, and companies like Advanced Micro Devices, Micron, American Airlines, and UPS were all down double compared to what the market was. So if we had done in-depth research on any of these companies, well, has anything fundamentally changed? If it hasn't, then perhaps this crash is the opportunity we've been looking for. The questions we want to ask ourselves is, does cash flow get hurt by the outlook now? Let's say if a recession were to come. Does earnings get hurt? If they don't, there could be an opportunity there. Now, with those particular companies, earnings and cash flow would probably get hurt, but that's a topic for a different video. Now, to my way of thinking, the stock market in 2018 is the type of market that can help you create outperformance. If you want to beat the S&P 500 with your stock picks, then I believe this is the ideal market to do just that. If you're patient and you focus on the long term, focus on profits, focus on where the opportunities present themselves, then you just have to sit there, wait for it, and then take it. Keep doing great research, and that great research will lead to great opportunities when you're willing to go against the grain. And this brings us to dividends. One of the best parts of dividend investing is many times dividends can be consistent and predictable. In fact, I've gone ahead and built portfolios for people that I know that the entire goal of that portfolio was to provide consistent dividends for those people. And I always try to warn people that are looking to build this type of portfolio that they have to try to ignore the volatility of the market and even the individual stocks. For that type of portfolio, the main focus that I have when I'm researching those stocks is the sustainability of that dividend. And assuming that the dividend is going to remain the same, that's a big assumption, but let's assume it remains the same. The dividend yield, when you bought into the stock, will get locked in. So let's imagine that you bought a stock at $10 per share. And let's also imagine that they pay 50 cents every year as a dividend. Well, your dividend yield is 5%. Well, if that stock falls after you buy it to $8 and then jumps in year 1, and then year 2 it jumps to 12, and then year 3 it's back down to 10. If they kept paying that 50-cent dividend, well, you would have received 5% dividend yield on your initial investment. Now, if the dividend had been increased, you would have received a higher dividend yield. If it had been decreased, you would have received a lower dividend yield. It's really that simple. And this is important because ultimately, a dividend yield is a reflection of the dividend and the price of the stock. So if the stock market crashes like it did yesterday, well, that same stock, let's pretend you hadn't bought it yet and it falls down to $7 per share. Assuming they're going to keep paying the 50-cent dividend, well, your dividend yield is now a bit over 7%. It doesn't matter what the underlying stock does from that point because your dividend yield, as we just demonstrated, will continue to stay at the 7.1%. That being said, let's say you want to build a portfolio of a dividend portfolio that's going to get at least 5% a year. And maybe there was a stock that you were interested in, but it only had a 4% dividend yield. The stock market crash happens yesterday. Fundamentally, nothing has really changed about the company. So now the stock is paying a bit over 5% because the stock price fell off, because there's an inverse relationship between the stock price and the dividend yield. This might be the perfect opportunity to go find that company that didn't quite have enough yield, jump in and buy it when it's cheaper, and lock in your dividend yield. Once again, assuming the dividend stays the same, hopefully it improves, and then you do even better. So one final tidbit I came across when I was doing my research for this is that it was interesting to see that historically, December is a very good month for the stock market. Does that mean the stock market's going to turn around? Maybe. I don't know. Take it for whatever it's worth. So that being said, I appreciate you sticking around all the way to the end of the video. And if you're not a subscriber yet, hit the subscribe button. It's tons of fun. And any questions or comments or any ideas or thoughts you might have, post them in the comments below. And I'll see you in the next video. Thanks.